What's the story ahead for November? Well, joining me now is Dave Mazza, the Chief Strategy Officer at Roundhill Investments. He just launched a brand new dividend ETF called Dividend Monarchs ETF, ticker KNGS. John Mayer, CIO of Global X, and Todd Rosenbluth, Head of Research at Verify. Guys, thanks so much for joining me today.
Yeah, no, thank you for having me. So the new fund is the Kings ETF, ticker KNGS. And it's named that for a reason. It focuses on the dividend monarchs.
A dividend monarch refers to companies that have consistently increased their dividends every year for a minimum of 50 years. These companies have demonstrated resilience through various economic conditions and have consistently rewarded shareholders with increased dividends.
So for investors who are concerned about the market outlook or just looking for an opportunity to increase the income potential and total return of their portfolio, focusing on companies that have the consistency and reliability as the dividend kings, the dividend monarchs, could be an opportunity for them.
Dividend ETFs are generally viewed as safer bets in times of economic stress due to the diversification benefit they offer. They can be more appealing to investors when bond yields come down, as they can benefit from the upside in the stock market while also getting some downside protection and stability with dividends.
So you've got Dave's new ETF, Kings, which is a version of the SPDR S&P Dividend ETF, SDOG, which looks for companies that have 20 plus years of dividend growth. That's over 120 companies meet that criteria. And that's going to include some technology companies, some financial companies that you're not going to find in that 50-year version. You also have many dividend ETFs that are focused on the dividend yield. And so SDOG, which is an ALPS sector dividend dog ETF, is one of those ETFs, equally weighted across all of the sectors in the broader market, 5 companies per sector. You get the benefits of diversification and a higher yield, a higher income for those that are looking for an alternative to bonds in this kind of environment.
Traditionally defensive sectors include consumer staples and industrials. These sectors are often less affected by market volatility and economic downturns, making them a safer bet during uncertain times.
So the 36 names definitely have healthy defensive exposure, but what I find most interesting is in this ETF, there's no exposure to IT and no exposure to communication services. So for investors who are looking to reallocate away from those names that have led the market higher this year, as we perhaps are concerned that maybe we are finally seeing the signs of a recession come to bear, particularly with last month's job numbers, something like the Dividend Monarchs ETF can be an opportunity for them.
The statement that bad economic data might be good for the market refers to the idea that negative economic indicators can lead to actions by central banks or governments to stimulate the economy, such as lowering interest rates or increasing fiscal spending. These actions can boost the stock market.
It's important for the market to see an end. Right now, the market is looking at money market funds at 5.5% rates. And the market, the financial advisors, investors are overall being complacent from my perspective. And they're being complacent because 5.5 is a good yield. Can we stick with that? But longer term, if you miss, say, the 10 good days, best days in the market for the year, you're really going to miss that entire return. So you want to be positioned correctly. And we do believe that equity income is a place that for investors to be allocated to for some portion of their overall portfolio.
A range-bound market refers to a situation where prices oscillate between a low and high range for an extended period, without trending up or down significantly. In such a market, strategies like covered calls can be effective. Covered calls involve selling call options on stocks you own, which can generate income, the premium from selling the options. This strategy can provide some downside protection and is particularly effective in a range-bound market where large price swings are not expected.
We believe covered calls make a lot of sense right now. Covered calls are, whether it be QYLD, our NASDAQ 100 covered call product, or XYLD, our S&P 500 product, you're getting paid to sit in the market, and if you expect the market to be range-bound, and we do expect the market to be more range-bound for the rest of the year, those are good places to get 12% yields, and you're somewhat cushioned on the downside with option premium received.